Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, tonight, we're going to be talking with Steve Eisman. Steve is the managing director with Neuberger Berman. Now, if you ever saw the movie The Big Short, actor Steve Carell portrayed Eisman as the investor who shorted the financial markets in 2008. Well, tonight, we'll be having the interview of the real Steve Eisman about his thoughts on the health of the banking industry, the economy, and we're going to ask him, is he shorting as he did in 2008? Steve Eisman coming up. We're here, you're there, and for the next 28 minutes, this is Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I'm Andre Laborde. For it's Friday, November 3rd. I hope you had a good week. Well, let's get right to our interview. We did a couple of weeks ago with investor Steve Eisman. Now, due to the time, we had to edit a portion of it out, but we wanted to bring it to you in its entirety. Steve, with the banking and financial crisis of 2008, he saw a crisis coming, and he shorted the financial instruments known as CDOs, or collateralized debt obligations, so that if banks started to go down, which they did, then his portfolio would start to rise. So, here with that full interview is Steve Eisman.
Thank you for having me.
Steve, with the events this week with the Middle East of Israel, Hamas, Iran, does that alter your investment strategy in any way?
God, I wish you hadn't asked me that question.
And at the very beginning, too.
I've been too much in a state of shock and rage, really, to be able to think clearly about it. I mean, I never thought that I would see mass pogroms happen again in my lifetime, because I thought that's what my grandparents left. And I've tried to think about it somewhat during the day, and I cannot, unfortunately, I have been looping on a quote that I learned a long, long time ago when I used to study Talmud, which in the original form was Habala hargecha hashkem lahargo, which means when your enemy is coming to kill you, get up early in the morning and kill them first. And I just can't. It's going to take me days to process this. It really. As
I think most people are the same way. People in the United States are still in the state of shock. Do you think that oil will be going higher for longer?
I have given up a long time ago trying to predict oil prices in any particular way. As I like to say, it's above my pay grade.
I was young at the time, but it was on October the 6th, which was one day before this tragic event, but in 1973 with the Yom Kippur War. And because the United States sided with Israel, the Arab states were upset, and we had the gas lines, and it was so bad that many people may not know this, but I mean, who were not around or too young, but the last number on your license plate, if you had an even number, you were allowed to get gas on one day. Odd numbers were you.
I remember I used to sit in line with my father.
Yes.
When used to do it.
And it was the same way with me, Steve. Same way. I'm curious, do you think oil is diversified so much now that we won't be going back to those days?
Oil as a percentage of the U.S. economy is so much smaller than it used to be. We're much more diversified. And nor do I think that, this is just my personal opinion, I don't think that what's happening in Israel right now is going to have any impact on the flow of oil. I don't think the Arab nations are going to do anything about that one way or the other. They'll keep flowing the oil. So I don't think that is an issue.
From the beginning of the year, from January 1st till the end of June, we had something like and I'm talking about major bankruptcies of companies of $1 billion of assets or more. We've had about 16 of them. And I'm thinking of, Bed Bath & Beyond, Yellow Trucking, others like that. Do you see that, we're in the fourth quarter right now. Do you see more business bankruptcies coming up?
I mean, the number of business bankruptcies so far this year has actually been small. Credit quality in the United States is actually superb, which is my area of expertise. Consumer credit quality is very good. I mean, it's starting to normalize a little bit, but it's normalizing from a level that is so low that it's not going to have an impact on the economy. Commercial business bankruptcies are still very, very low. Bank balance sheets are in good shape. The only area that's eventually going to be a problem is that everybody knows is commercial real estate. But that's a problem that I think will largely be confined to that sector. And it has what we like to say in our business, a very long tail, meaning consumers will, if there are problems, will default quickly. Businesses take a long time. So this will be a long, slow evolution of the situation. I mean, is it possible that eventually we'll have a recession? Sure. Although there's no data at this point to say that there is one coming. I mean, even those economists out there who I respect, who are predicting a recession, would be the first to admit that there's actually no data currently that there's a recession on the horizon. I mean, everybody saw the jobs data on Friday, which was kind of shockingly very strong. So, and the other thing, I get I do a lot of interviews in my life, and and no offense to you, but people are like begging me to say it's a calamity, it's a crisis, it's happening again, and it's not.
Well, I remember either reading what you said or seeing another interview show that you had done where you said that this is the most anticipated recession that has not happened. So
Correct.
Yeah, if I had the words about right the way you said it. So
now, not only do you have the words right, but they're actually not my words. I'm quoting my sister, who made it up first.
Well, we want to give proper credit, so we'll give credit to
Let's
both.
give proper credit where credit is due.
To both Eisman families members. Okay. Well, what about, you brought up about commercial real estate with REITs, real estate, let's say take about real estate investment trusts. And specifically, I'm thinking about commercial office REITs. So you're looking at landlords who do they have the tenants, which means can they pay the note? And when those notes come due, are they going to have to roll them over because they don't have the money to pay the loan? Will banks let them do it because they don't want the real estate? What do you think is going to happen?
Well, you're actually seeing it. Interestingly, usually in a credit cycle, whatever the credit cycle is, the weak hand goes first. And then if it lasts a very long time, even the strong hand goes. But interestingly enough, in the last 6 to 9 months, people like Blackstone, Brookfield have actually given A quality buildings back. They've given the keys back to the banks because they know that eventually the debt's going to have to be refinanced 2025, 2026, let's say. They don't have the tenants. They don't have the rent rolls. And so they gave up. You're going to see a lot more of that. I don't think banks are going to be too. Now, there's one thing in the banking business that they sometimes do, which is they like to call extend and pretend, meaning they'll just roll over the loan at the same rate and hope the problem goes away, which is why these problems tend to evolve slowly. But they'll evolve.
More regional banks do the real estate loans, from what I understand, than the large ones. Are we looking at problems coming up in the foreseeable future for not just the small regional banks, but maybe even the larger ones as well?
Well, the large ones, when they originate commercial real estate loans, will package them and put them into commercial mortgage-backed securities. So the last time I looked,
well,
it's something like
Steve, that sounds like a harbinger of back in 2000 mortgage-backed securities. You're not going to bring up collateral debt obligations, are you?
Look, I could start to go into my comedy routine about calamity happening. It's not, when you compare the size of the residential mortgage market versus the commercial real estate market, the residential mortgage market dwarfs it.
Okay.
So this is going to be a problem. About 60% of all commercial mortgages are held in commercial mortgage-backed securities, so that'll be a problem for their investors. And about 40% are held by regional banks, not the large banks, and that will be a problem for some particular banks. And with respect to those banks, regulators might have to do something, but it's not going to happen today. It'll eventually happen.
Michael Barr is with the Federal Reserve, and I think he is either recommending or he can demand. I'm not sure his power, but he's
No,
saying
he has his power. Let me give you the regulatory lay of the land.
okay.
After when Dodd-Frank was passed, a new position was created in the Federal Reserve called Vice Chair of Financial Supervision.
Right. Okay.
Which is just a fancy word of saying Chief Bank Regulator of the United States of America. It's actually a shocking statement to say that before Dodd-Frank, there was no chief banking regulator of the United States of America, which doesn't exactly say a lot of wonderful things for us. But
right.
But currently, Michael Barr is vice chair of financial supervision, so he has a lot of authority.
Well, he was saying how, if I understand correctly, that he wants now banks to have 20% more cash reserves on the sideline for banks. And I'm assuming that's both regional and also major banks. But if they're going to raise the cash
capital, not cash reserves, there's a big difference.
Okay.
Unfortunately, what I think Vice Chair Barr is doing is, I'm trying to remember the quote. Generals like to fight the last war.
Mm-hmm.
So, what was the last war? The last war was banks had a lot of bad credit, and they didn't have enough capital, and that all that bad credit was largely in the large banks, and the system blew up. So, after 2010. The then Vice Chair of Financial Supervision, Daniel Tarullo, increased the capital requirements, made the banks reduce risks, and made them keep a lot more liquidity on their balance sheets. But the liquidity aspect was only for the large banks. So one of the major reasons why Silicon Valley blew up is they were not required to have that kind of excess liquidity on the balance sheet. So what they did was they went out and bought some very large amount relative to their size of long-term U.S. Treasuries, and when rates went up, they were underwater. And then when their depositors, venture capitalists, started to pull the money, they had to sell the bonds at a loss, and goodbye Silicon Valley.
Do you think that there will be more banks that are doing that? They just haven't uncovered them yet, that are doing identically like what Silicon Valley Bank is doing by buying long-term treasuries when they actually need it short-term?
Well, that ain't an easy question to answer. But what I would say is that Silicon Valley went under for two reasons. One was they had a lot of bonds that they had massive losses in. That's not enough to sink a bank. What you also need is depositors fleeing, so you have to sell. And not clear if that's going to happen to other banks, but hopefully the regulators will have time to work it out.
I mean, I think with Silicon Valley, they insured depositors up to their above their $250,000 level. That they went. I mean, they actually didn't. No, they actually didn't. All right.
They said they would.
Okay.
But then they didn't. They created some programs that gave those banks liquidity, and they hoped the problem would go away. So technically speaking, your deposits are not guaranteed above $250,000. I don't think most people know that.
Right. Well, that's what I get for only reading the first paragraph and not the second paragraph.
Well, what happened was you listened to the government that Sunday night,
yeah,
but you didn't listen Monday morning.
You know, you always got to listen to part two on Monday morning.
Listen to the end of the sentence.
It's a whole different scenario.
Whole different scenario.
Well, you know, Steve, the definition of insanity is sometimes doing the same thing over and over again, thinking you're going to get a different result. And I remember a couple of months ago, the government, I think it was the Biden administration, said that to get people to get in more home ownership, what they're doing is they're going to lower the credit rating so that if you have a lower credit rating, you'll be able to get a lower bank rate. But if you have a higher credit rating, in other words, you've got stronger credit, you're going to have to be paying more.
Yes.
What do you think?
One will Well, it's not. Look, again, it's above my pay grade. It's not an insane idea in the sense that the people who can really afford, have the perfect credit. if they pay a little bit more, they'll subsidize the other people who can't afford as much. It's not a crazy thought. The only thing I would say about the mortgage market currently is that credit quality is impeccable. But that's not the problem with the housing market. The problem with the housing market is that pretty much everybody who owns a home today has a 3% mortgage. People who want to buy a home today the current mortgage rate is like 8. So, one thing I learned very clearly when I was in grade school was that the number 8 is a lot higher than the number 3, in case anybody wasn't paying attention. And I actually calculated that if, let's say somebody bought a house, just make up a number, for $300,000. It doesn't matter, actually, the number, but let's just say $300,000, and you had a 3% mortgage. For somebody to buy your house today at an 8% mortgage, to have the same monthly payment as you do with a 3% mortgage, the house price has to be cut in half.
Well, I would imagine, Steve.
The house price has to be cut in half. But here's the caveat.
Okay.
As long as people have jobs, they're not going to sell their home for half. So what the situation in the existing housing market today is there are no sales, because nobody wants to sell their house down, especially when they have a job. And the people who want to buy don't want to buy the house at the same price because the monthly payment's too high.
But do you think that there are more people with lower credit ratings than higher credit ratings? So if like you say, if one oversets the other, if the people with good credit are subsidizing those with bad credit, I mean, I remember, and I know you do, like back in 2007 or prior to that, Barney Frank, who at the time was congressman from Massachusetts, said, let's roll the dice, see what we get. And they rolled the dice and see what they got. He rolled them.
He rolled them. But you know what? It's a little unfair to say that Barney Frank actually rolled the dice, because the bad mortgages, most of them were in the subprime market, which was really an unregulated market. The government really didn't. I mean, Barney Frank liked to say that he rolled the dice. He didn't really roll it. Wall Street rolled it for him.
Okay. Well, like we were talking before about Dodd-Frank, are there more rules on the subprime mortgage that what happened in 2007 and 2008 won't happen again?
There are no subprime mortgages made in the United States today. Almost none. It's just not done. It's just not done.
Okay.
It's a shocking statement. I mean, it used to be a $500 billion a year volume business.
Mm-hmm.
I mean, the amount of subprime mortgages that are made in the United States are probably so small it's a rounding error. It's just not done.
Are you shorting any banks right now?
Well, I don't short anything for clients anymore. We're long only.
Okay.
And the only type of shorting that I have is just in my own personal account, and I'll just keep that information to myself.
Okay. Well, how about if I ask it this way? What type of banks, what type of sectors do you think that are too overvalued?
What kind of sectors do you think are too overvalued? I don't really think of it that way, per se. I mean, you could make an argument that parts of tech are overvalued, but on the other hand, it's the most dynamic part of the U.S. economy. If I think something is overvalued, that doesn't necessarily mean it's a calamity is approaching, unless the fundamentals are about to deteriorate. One of the things that let me put it this way: on the long side, buying something because it looks cheap is usually a value trap. Mm-hmm. And shorting something just because it looks really, really, really expensive is usually a recipe for losing a lot of money.
Okay, well, let's say if a client comes to you at Neuberger Bergen and says, Steve, I'm thinking about getting into crypto. What would you tell them? And I'm sure because I have people calling and asking me about crypto, so I know you must really get the calls.
Mm-hmm. So if a client came to me, well, some clients did come to me and say, do you think I should, I'll give you the exact conversation that I had. I had a client call about 2 years ago to say, everybody's telling me to buy crypto. What do you think? And I said, look, you're my client, but I run your money on a discretionary basis. So if you're asking me, would I personally, Steve Eisman, take money invested in crypto? The answer is absolutely not. And the reason was, and will be that, first of all, I don't think crypto is a currency, but let's leave that aside. The thesis behind the people who say invest in crypto they argue the following, which is that government-issued currency, which is technically called fiat currency, they argue has been debased because of all the deficit spending that all governments have been. And so inflation is coming, calamity is coming, Noah's Ark is coming, et cetera, et cetera. And if you want to hedge yourself against the debasement of currencies, buy crypto. It's like a hedge against disaster. So, okay, let's accept that as a given. So if that's the case, crypto should do very, very well when times are getting tough, the Fed is raising rates, inflation is rampant, people are nervous, they're risk off, they're selling their tech stocks, they're looking to hide, etc. And crypto doesn't act like that at all. The correlation between crypto and high growth tech stocks is about 60%. So to me, it's become quite clear that crypto is just another way for people to speculate who have nothing better to do with their lives. Okay.
What about we're talking about banks, and we're talking about bank stocks and with depositors. At one time, there was like a little over $5 trillion in the economy in cash reserves. But now people are taking money out of whether it be COVID money drying up or whatever the case, but there's not as much as it once was. Do you see private credit rather than banks? Because remember we talked about Michael Barr just a little while ago. So if first off, do you think banks are going to be more stringent on their loans? And if so, with more businesses having problems, are they going to now go to private credit as a possibility of getting bank loans?
Yeah, the answer to that question is yes, yes, and yes.
Okay.
So let me elaborate on 3 yeses. So during COVID, because of all the money that came in and nobody had anything to do, trillions of dollars went into the banking system in the form of deposits. And now that rates are up, that money is leaving and going into money market funds. There's probably something like $2 trillion worth of excess deposits still in the banking system. And I think over the next couple of years, assuming rates stay up, a lot of it will leave. So if you're a bank and you're losing deposits, that means you have to make fewer loans because the deposits are the way you fund your loans. So throughout the banking system, you are finding banks are tightening their credit. If you're a bank and you're tightening credit, but the economy is still good, somebody else is going to make that loan. And that's happening now in the outside of the banking system with companies like Apollo or Blackstone or some of the
BDOs,
what you call small business,
BDCs,
BDCs, et cetera. Mm-hmm. And that's going to continue.
More so, it'll increase the percentages of going toward those areas of bank business development companies rather than to the regional banks and such for getting loans?
I think that this will last several years.
Okay. Mm-hmm.
But that isn't to say you won't be able to get a loan at the bank. You'll be able to get a loan at the bank, but the bank is definitely going to tighten, and that does mean that a lot of good credits are not going to be able to get a loan at their bank, and they're going to have to go elsewhere.
What about last week? We had John Stoltzfus on the show, and John is the chief investment officer at Oppenheimer Asset Management, and he said that industrial stocks he was very high on because with government money being put out for bridges and other types of industry, that he liked that sector.
It's first of all, there's about $1.2 trillion that the United States government is going to spend in the form of either direct spending or tax credits that will be in a bunch of different areas. I think this is a massive opportunity to invest in over time. And yes, I'm very, very positive on it.
Steve, I've got a lot more questions, and I hope you come back for a part 2. I thoroughly enjoyed it.
Okay, thank you very much.
Thank you, Steve. Well, if you've got a question or maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benecapital.com. Let's take a look at the markets heading into next week. But before we do, what television company was established on this day in 1969? We've got the answer, and it's coming up. On this day, what television company was established in 1969? The Public Broadcasting Company, also known as PBS. And now for a wrap-up on Wall Street. Americans are falling behind on their car payments as their highest rate in nearly 30 years. The percentage of subprime borrowers who are at least 60 days late on their loans rose to 6.1% in September. Now that's the highest rate since 1994. And the data showing that Americans rang up $105 billion in credit card interest last year alone. And according to the Consumer Financial Protection Bureau, 1 in 3 subprime borrowers were in deep or persistent debt, which is up from 25% in 2021. Well, which states are the top tippers? Top states for tipping are, well, if you're a waiter or a server, you want to be in California as number 1, followed by Missouri and Florida, followed by Arizona and little old Rhode Island. But of course, if those are the best, which ones are the worst? Well, those would be number 1 worst state for tipping is Illinois, followed by Mississippi, South Carolina, New Mexico, and in 5th place goes to Tennessee. So with the Federal Reserve having their meeting this week and one more meeting in December, how will November and December look for investing? Now, there's only 34 more days left for trading in 2023. Well, will we be seeing that hoped-for Santa Claus rally? Join me next week when we'll be talking with Victoria Fernandez. Victoria is the Chief Market Strategist at Crossmark Global Investments with just under $5 billion of assets under management. That's Victoria Fernandez next week. And that's a wrap-up for our show this Friday, November 3rd. Our thanks to Steve Eisman for being with us tonight. Always, though, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.